Good afternoon. This is Sean Golding with Golding and Golding, here to discuss the basics of international taxation. We get lots of questions. At our firm, we specialize almost exclusively in offshore disclosure, unreported foreign accounts from prior years, the disclosure programs, expatriation, but we get a lot of basic international tax questions. There's a lot of misinformation online, and so we thought we would provide sort of a primer on international taxation. It's by no means comprehensive. It's just to give you kind of a taste of what to look for, some issue spotting help, things like that. So, first things first, right? The United States, unlike almost every other country across the globe, follows what's called a citizenship based taxation model. Most countries do residency based taxation, which basically means you live in a country, you're considered what's called a permanent resident of that country, typically more than 6 months you reside there. They can tax you on your worldwide income. Makes sense. The United States doesn't like to doesn't want to go with the grain, so they do citizenship-based taxation. There's two problems with that. The first is it's not limited to just citizens. It includes U.S. citizens, lawful permanent residents, foreign nationals who meet the substantial presence test, which could include people on like an H-1B, an L-1, O-1, EB-5, E-2, E-3, even if you're not on a visa, right? But typically you come over here from another country, work transfer on an L-1 or H-1B, and you live in the country long enough to meet the substantial presence test, then you pay tax on your worldwide income. But you could live overseas as well, have all of your money sourced from foreign countries, and you still have to pay tax on your worldwide income, even though you're not a resident of the United States. Worldwide income includes U.S. and foreign income. It's super common for clients to come to us and go, "Hey, I have assets in Taiwan, so I pay tax in Taiwan. I have assets in the U.S. I report my U.S. assets." But the U.S. is a worldwide income taxation model, which means you have to include income from everywhere. In addition to earned income, lots of different types of income can be taxed, and this can get complicated because in a lot of foreign countries, the income may not be taxable. It may be exempt, but unfortunately, typically, unless you qualify for a treaty election or the closer connection exception, which we'll get to in a moment, income is taxed. So, once you become a U.S. person, foreign trust income is taxable if you are the owner of a grantor trust, if you receive a distribution from a non-grantor trust. If you have ownership in foreign corporations, it can get infinitely more complicated depending on whether it is a controlled foreign corporation, a specified foreign corporation, if there's subpart F income, GILTI, global intangible low taxed income, and all that fun stuff. Interest, dividends, capital gain, rental, royalty, all taxable. Okay. Now, taking a step back, if you are taxed in the foreign country and you already pay tax or it was withheld or you filed a return, you may qualify for what's called foreign tax credits, so you can apply taxes you paid in the foreign country in the United States. It's not always dollar for dollar. You can't use the foreign tax to offset U.S. sourced income. And there's a whole calculation that's used. It's Form 1116. But at the end of the day, you may be able to bring down or eliminate any double taxation issue. If you're in a low tax jurisdiction, typically you'll still owe taxes in the U.S. If you're in a high tax jurisdiction like Canada, Australia, you may have carry forwards. There's also something called the foreign earned income exclusion and housing exclusion. Even though the U.S. is taxing you on your worldwide income, if you live in a foreign country and you qualify that as your tax home in either the bona fide residence test, the physical presence test, then you may be able to exclude upwards, I think it's now $120,000 of your income, as well as certain deductions for housing. So two people living overseas making $250,000 between them can feasibly maybe not have any U.S. tax liability. If they live in a low tax jurisdiction, then they're beating the system, and that's good. If you are legally beating the system. If you are in a foreign country, you may be able to qualify for certain treaty elections, typically not if you're a U.S. citizen, but if you're a permanent resident and you live overseas, you still get taxed on your worldwide income like we said before, but maybe you qualify as a treaty election to be treated as a non-resident for tax purposes, which means then the U.S. would only tax you on your U.S. sourced income, depending on how much income you have between the United States versus what you have overseas. You may not have any tax liability. You still have to file returns. You file a Form 8833 treaty election along with the Form 1040 NR non-resident. It has to be a treaty country, of course. Now, in order to complicate it even further, beyond the tax issue, there is the reporting issue. U.S. persons, and that's just not only, we're focusing on individuals, but that includes any U.S. person, domestic entity, trust, et cetera, et cetera. If you have foreign bank accounts, investment accounts, mutual fund accounts, ETFs, foreign life insurance policies, foreign pension plans, other types of pooled funds like SECOVs, you have to report all of this information annually on a myriad of different international information reporting forms. Depending on the category of asset and the value, you may have to file several forms. You may have to file some of the more complicated forms. You may have to file the same form for multiple assets. So let's just say you had a few bank accounts overseas. They're typical current account or a fixed deposit, something along those lines. Then it's not that bad. It's typically the FBAR and the Form 8938, depending on the value. If you got foreign corporations, depending if it's a controlled foreign corporation, you may have infinitely more complicated reporting on Form 5471. If you have foreign partnerships, it's 8865. Foreign trusts can get super complicated as well. It's Forms 3520 and 3520-A. And another complication with foreign trusts is something called the throwback rule, depending on whether you're getting distributions every year. If they're staggered, you may have to complete, I think it's Form 4970 for accumulation distributions and throwback rule and et cetera, et cetera. It gets really complicated. So if you can, it's better to try to plan before becoming a U.S. person if you became a U.S. person through green card or visa, things like that. The treaty election, I talk about that again here because it can mean the difference between a very high tax liability and no tax liability. So let's say you're a U.S. person, you're living in Australia, and you're receiving a large amount of superannuation distribution. The super gets taxed while it grows, but typically not at distributions, different than a 401k, for example. 401k doesn't get taxed as it grows, hopefully, growing. And then when it's distributed, you pay tax at your OI, ordinary income tax rates. So if you're a green card holder, you're living in Australia full time, you want to try to make that treaty election so that, maybe if that's the only source of income you really have, you're in retirement, or all of your income sources are coming from foreign countries, you may be able to avoid U.S. tax. Let's go through some of the more important facts and myths that we hear here. One that's not on here that's something to keep in mind is, I hear this from expats a lot. They were living in Costa Rica or somewhere and they're at a bar and people are telling them, hey, once you've lived outside of the country for 10, 15, 20 years, you don't have to pay tax anymore. That's not true. Don't flaunt that. There's ways to do it, but just living outside of the U.S. is not sufficient. One common myth is that the IRS can't get you overseas. That's not true. Over the past several years, going back to like 2014, the IRS has entered into over 110 FATCA agreements, the Foreign Account Tax Compliance Act. So they communicate with different countries. These countries enter into reciprocity agreements, IGAs, intergovernmental agreements between the United States and the foreign country. And information flows back and forth. There's exchange of information. So the countries know about the different assets. The U.S. knows about your assets overseas. Just because you haven't been audited yet doesn't mean they don't have that information. There's other agreements as well, and reciprocity agreements, and et cetera, et cetera. The U.S. works with lots of foreign countries like Canada often. And so, if you're hiding assets in Canada, think that they can't find you there, the IRS and the CRA work together. So something to keep in mind. And one more thing before we go any further. We're not a fear-monger type of firm. They're out there. They're absurd. Most of the time, taxpayers do not have any sort of penalties, any criminal violations. It's just a matter of getting into compliance if you're not in it or if you're just starting out to try to do it the right way. And if you're out of compliance, there's different amnesty programs that we'll get to in a moment that you can use. But for the most part, you just kind of want to get it right, because if you owe tax, then you can owe penalties. If you don't report, you can owe penalties, and then you owe interest on those penalties, and it accumulates and it compounds, et cetera, et cetera. If you're living overseas, another myth is that if you're living overseas, that out of sight, out of mind of the IRS, that's not true. If you still have assets in the U.S., IRS, 401ks, bank accounts, properties, the IRS can put a levy on your account or on your payroll if your payroll is coming from the U.S. Maybe you're at a foreign branch of a U.S. company. They can put liens on your property, notice of federal tax liens. They can seize property. That's less common. Written ag stat and other way more complicated things. But most of the time, they will either send you a levy or a lien. With a levy, they'll normally give you a whole bunch of warning notices. The liens, not so much, but you can get them removed if they're wrongful or once you pay it off. Another thing that's been going on a lot more recently is the passport revocation. They do it if you owe a substantial tax debt. They can come after you, I think, with it's $50,000, but adjust for inflation, so it's probably closer to $55,000. Doesn't include FBAR penalties. So if all you have is FBAR penalties, they generally cannot revoke your passport for that. There are different types of penalties. If you forgot to file your FBAR and you go online and you read some nonsense, you're going to think, oh my God, I'm going to go to jail for 50 years. There's different types of penalties. Majority of the time, they're civil, non-willful penalties. You could also have something called civil, willful penalties, which are typically a lot worse, but a lot less common. Criminal penalties are almost unheard of in your typical type of situation. If you did tax evasion or tax fraud, you're structuring, you're smurfing, you're laundering money, then you're going to subject yourself to criminal penalties, but it's not something that's super common. And just because you're out of compliance or you didn't get it right before doesn't mean you can't fix it without having to deal with all those headaches. If you're out of compliance, the IRS has developed many different programs to help you get into compliance. Let's go through them real quick. VDP is the Voluntary Disclosure Program. There used to be something called OVDP, which is the Offshore Voluntary Disclosure Program. They got rid of that at the end of 2018. I think it was September. Now it all falls under the moniker of VDP, whether it's offshore or domestic. But that's for people who are willful, okay? There is no bright line test to determine willful versus non-willful, but it's a totality of the circumstance. And just because you have regret that you didn't do it right the first time does not mean that you are willful. Do not let attorneys, accountants, CPAs prey on you that way. You know, people can tell if, you know, you're sounding very apologetic, which is great, but that does not mean that you are willful, okay? If you're not, and the penalties for that program are very stern, and you have to certify under penalty of perjury that you're willful, so, you know, you want to be careful with that if you weren't really willful. There's a lot of programs if you're non-willful. There's something called the Streamlined Filing Compliance Procedures. There's something called delinquency procedures. Delinquent FBAR procedures is different from the Delinquent International Information Return Submission Procedures. You might see it as DIIRSP. It's a great program, but they did away with the automatic penalty waiver back in November of 2020. So if all you have is the FBAR, no unreported income, you could typically do delinquent FBAR. If you have anything more than that, you want to talk to a board-certified specialist before you do anything. Reasonable cause is great if you qualify, because if you qualify for reasonable cause, they can't penalize you at all, and if they did, they have to abate the penalties. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.